Hidden bearish convergence of type B. Is there anything simpler? Divergences, convergences. Divergence, divergence. Convergence, divergence. How to make money on this? Watch this video. I guarantee you that you will no longer have to spend time watching dozens of videos on the internet, because everything you need to know about divergences and convergences, I will tell you in this video in 10 minutes. Hello everyone, my name is Roman Kornev and you are on the channel about professional trading and investments. Today, we will talk about what divergences, convergences are and how to make money from them. If you haven't subscribed to the channel yet, be sure to subscribe, because every Monday I make releases with signals for profitable trades. And everyone who is in my community, including in the Telegram channel, a link to the Telegram at the bottom, subscribe. We all earn from these signals, so join us. So let's go. In general, divergences and convergences are used in various indicators such as MACD, RSI, stochastic, oscillator and others. Which indicator to use divergences and convergences with is up to you. But in order to apply it correctly, you need to understand the very structure of this phenomenon. Divergence is a discrepancy. That is, when the price goes one way and the indicator shows the other. What exactly in the indicator shows the other side? We'll see now. In turn, convergence, on the contrary, is convergence. That is, when the price goes down, for example, and the indicator goes up, that is, they converge. Some traders confuse convergence with divergence and call convergence divergence. In fact, this is wrong. Use the correct terminology to be literate. We also need to understand that there are two types of divergence and convergence: classic and hidden. Classic ones are when they show a trend reversal. Hidden ones when they show a trend continuation. Also, classical and hidden divergences and convergences are divided into three types: A, B, and C. The theories are finished. Now we move on to practice. Classic bearish divergence of type A. It may sound complicated, but in fact, it doesn't really matter what they are called. It is important to identify them on the chart. This is the most important thing, because if we identify them, then we can make money. If not, it doesn't matter what it's called. This is the strongest signal, the most common when the price goes up and the indicator goes down. What do you mean it's coming? First of all, we need to understand that the price should form a certain extreme. What is an extreme? This is either the maximum or the minimum. When the price goes up first, then turns down, an extremum is forming. After another extreme has formed, we can conclude that there is a certain trend. The highs are rising. I'll call it the price is going up. At this time, the indicator also shows some extremes, when the bars or lines of the indicator first rise, then fall. After this happens at least twice, we can also say that there is already a certain trend. In this case, the downward trend. Let's look at this with an example. Here we see the chart of the euro against the British pound. And on the chart we see two highs or extremes, the first and the second. There is an upward trend between them. At the same time, we see that the indicator, in this case the MACD, is trending downward. That is, the first maximum was higher, the second lower. It turns out that we have a divergence, a discrepancy. The price goes up and the indicator goes down. How to make money on this? There is a key point here. Please note that when the indicator completes the formation of a vertex, at that moment you need to sell this instrument. At this time, the price also completes the formation of the maximum. At this point, the best point to enter the sale. We sell the euro against the pound and earn on its fall. You might ask, is it that simple? On the one hand, yes. Come on! But what's the catch? The fact is that it doesn't always work 100%. To accurately determine, you need to apply certain filters, which I talk about in training. But now we need to understand the main structure. So let's continue to look at the examples. Next comes the classic custom convergence of type A. That is, the lows of the price decrease, and the lows of the indicator rise, and they converge. That is, convergence is obtained. Let's look at this with an example. Some say that this only works on currencies, but it doesn't work on cryptocurrencies. In fact, it works in any market. Here is a Bitcoin chart for you. We see that Bitcoin is showing declining lows, and at the same time, the indicator also shows lows, but they are rising, have an upward trend, and we have convergence, that is convergence. Thus, at the moment when the lower minimum is formed on the indicator, we can buy Bitcoin, and we can earn on growth. This convergence is called bullish because the indicator gives a signal for growth. The previous divergence gave a signal for growth. On sell, on sale, it was bearish. Bearish divergence and bullish convergence of type A are the strongest signals for finding reversal points on the price chart. Entering the market using such signals with properly applied filters gives us almost 90% of profitable trades. Study charts, look at trading instruments, and you will always find this divergence. Let's move on. Classic bearish divergence of type B. In this case, the price is rising, but the indicator is standing still. That is, the price peaks have an upward trend. The tops of the indicator seem to be on the same line, and although the indicator does not go down, there are still discrepancies. Let's look at an example. Here is the euro-pound chart. As we can see, prices are rising at the maximum, and the indicator is standing still. This signal is slightly weaker than the previous ones, but nevertheless, it also gives a good sell signal. As we can see, after that, the price immediately went down. You can earn money by falling. Next comes the classic bullish convergence type B. In this case, the price shows the lows that are decreasing. The indicator shows the lows that are standing still. Let's look at an example. Here we see, for example, the euro pound. Also, the lows are going down. The lows on the indicator are standing still. Accordingly, at this moment, there is a signal for a price increase. We can buy and make money on growth. And the last type is the classic bearish divergence type C. Well, convergence respectively. In the diagram, we see that the price is standing still, and the indicator, on the contrary, is moving down. So, let's look at the example. Eurofond. The highs of the price stand still, and the highs of the indicator show a downward movement. This is a good sell signal. You can sell it up here. Earns money by lowering the price. Yes, the movement here is such strong signals are not so strong, but nevertheless, it is also a good signal, especially for short-term trading. The second variant of the classical custom is convergence of type C. Here we see that the price minima are standing still, and the minimum of the indicator is on the contrary growing. That is, convergence is underway. Here we see an example, for example, of a stock. I am sometimes asked if these divergences work on stocks. Here you go, Apple shares. We see a bullish convergence of type C. That is, we have two minima, where the price stands still, and the minimum of the indicator rises significantly. That is, it is a buy signal. If we had bought near this minimum, we would have earned on growth. Few traders know that there are still hidden divergences and convergences. They are also divided into three types, but I did not load you and paint all three types. I think you have understood the scheme approximately. Now we will look at the examples only of hidden divergence and hidden convergence. Let's look at the diagram. As we can see, the maximum prices are decreasing, and the minimum indicators, on the contrary, are increasing. This convergence is quite rare. Let's look at an example. It is usually found in long-term declining or rising trends. Here we see a long-term downward trend, and we see the highs that go down on the price, and the highs on the indicator go up on the contrary. A hidden bearish convergence gives a sell signal, that is, a continuation of the trend. If classical divergences and convergences gave us a signal for a trend reversal, then hidden divergences and convergences give signals for a trend continuation. In this case, it is a sell signal, that is, a sell signal. Let's look at the latest divergence. This is a hidden bullish divergence, and it gives us a buy signal. As we can see, the lows of the price are rising, and the minimum of the indicator is decreasing on the contrary. A good example on the Eurofond. And now we see on the price chart the lows that are constantly rising. That is, there is a constant such a suitable trend. And at the same time, we see that we also have lows on the indicator, and they are falling on the contrary. There is not much decrease here. That is, it suggests that we have just three types there, maybe A, B, C. Yes, they can stand in one place, they can go down. That is, the main thing for us here is to understand that this is a divergence, and it gives a buy signal. That is, it is a bullish divergence. Accordingly, after the formation of the next minimum on the indicator, we can buy and continue to earn on growth. That is, on the continuation of the trend. I hope you are not too confused about the terminology. I understand that it can be quite difficult for the first time. In fact, we have considered 8 types of convergence and divergence in total. Save this video in a bookmark, or put a like so that it is saved in your favorites, so that on occasion you can get it, watch it again, and understand in more detail. Because when you meet the divergence, you may not understand what type it is. If you want to clarify this, you can watch my video again. Pause it, watch it slowly, and figure everything out thoroughly. As I said, divergences and convergences are used together with the MACD, stochastic, RSA, and other indicators, the so-called oscillators. By the way, I have a video about the stochastic oscillator. Be sure to watch this video. Also find it on my channel. I will make a video in the near future about how to work with the MACD indicator. If you have watched this place, then be sure to like it, because it costs nothing for you, and there is a lot of support for my channel. Write in the comments whether you use divergences and convergences, and whether you are able to make money from it. In the process of studying divergence and convergence and teaching this to my students, I noticed that some people are not serious about it. At first, they are interested in it. Then they say that yes, no matter how it seems to work, it's all complicated. In fact, people just don't have enough patience. Alexander Elder himself says that perseverance and perseverance are important in trading. The more you analyze the charts, the more you find patterns with divergences, and the better you see profitable entry points. If the video was useful to you, please like, subscribe to the channel, and we will meet you in the next videos. Bye bye.